Hi, my name is Jordan Weir, and I'm the founder of StocksAndOptionsGuru.com. Today, I'm going to be looking at relative strength and how you can use it to pick the right sector at the right time, while avoiding the worst sectors. I have an accompanying article on my website giving more detail about this topic. It's called Picking the Right Sector, and it was posted on May 12th, 2009. Without further ado, let's get to the stock charts. So now I'm going to go to StockCharts.com. You may have heard of it. Click on Free Charts near the top. And then on the left-hand side, under the Tools headline, you'll see something called Perf Charts. Click on that. Finally, scroll down until you see Amex Sector Spiders. Click on that. You should get to a page that looks a lot like this. One sec, give it a second to load. Okay, so on this page we can see various lines representing various sectors and how they've done compared to the S&P 500. If you click this histogram button under the chart on the bottom left, you can see the absolute numbers, which is much easier to analyze. As you can see, based on this chart, financials have outperformed the S&P 500 by 22% over the last couple months. Consumer discretionary is outperformed by 13%, and materials isn't far behind. Also, healthcare has underperformed by 12.35%, while utilities has underperformed by 12.91%. Now, those are all relative numbers, meaning that's how much they beat or lost to the S&P 500. If you click this button on the top left, it'll give the absolute numbers, what they actually did on their own terms. So financials went up 26.48% over that time frame. Materials and consumer discretionary both went up about 17 to 18%, while utilities and healthcare are both down about 8%. So now, you may be thinking, this is what's happened in the past. It's not indicative of future results. While that may be partially true, you have to remember that the big institutions, like mutual funds and hedge funds, are the ones who really move the market with their buying and selling activity. And it takes them a long time to build a position because of the vast amounts of money they're operating with. Because of this, the market tends to trend. You'll have bull markets, where the market goes up consistently for years and years and years, and you have bear markets, where the market tends to go down over a long period of time. Currently, we're having a short-term bull market in financials, materials, and consumer discretionary, while the bear market is still heavily affecting healthcare and the utilities. By using the fact that markets trend, you can then take advantage of what's been doing the best and get in there while it continues to do the best. Now, this is just what's happening in the short term. You can change the time frame you're looking at by moving the slider down here. So now, for instance, we can look at a whole entire year, for instance. Financials have been pretty negative, while healthcare and consumer staples have been outperforming. You could even look at 2 years. Over the last 2 years, financials have done the worst, while consumer staples and energy have been outperforming. This tool is most useful when you compare multiple time frames and you know what time frames to use compared to the time frame you're trying to trade on. If you're trying to trade on like a 2-month time frame, you should both look at the 2-month chart and perhaps a 6-month chart. If you look at the article, it goes into far more detail about how exactly to use it. I would strongly recommend you go to my website and check it out. Once again, my website is www.stocksandoptionsguru.com, and the article looking at it is called Picking the Right Sector. Thanks for your time. I hope you have a good day. Visit my website.